Hello guys and welcome back to the MD Investor channel. MD Investor channel where we talk about personal finance, setting goals, achieving goals, making smart money moves, and most importantly, taking action and breaking the cycle of generational poverty. Wayne Abraham, your personal finance host again for a new topic. And today, I figure we're gonna start a new series, guys. A new series in investing terms. A lot of times I realize you got to build a foundation before you start to build. Okay, you got to have a strong foundation. And I said, let's do this. Let's do this series so we can learn what things mean. Because we have to get some understanding. We have to get some understanding. So we're gonna go down the list. Okay, risk tolerance. They're all talking about risk tolerance, right? What does that mean? That simply means how much risk are you willing to take with your investments, right? From the most conservative person who say, I don't want to take too much risk, I want to have more bonds, to the person who is very aggressive, I want to be in all stocks, all equity. All right, and some of the considerations to have is someone who is younger can afford to be more risky, right? Because if they lose most of their money, they have time on their side to make it back. Okay? They have time on their side to make it back. And so that's what you want to consider when you're talking about risk tolerance. Remember the video we did on Acorn, right? Where Acorns put you in ETF, and I showed how, depending on your risk tolerance, you can pick the different portfolio, the more conservative, which have more bonds in there, to the more aggressive, which have less bonds and more stocks or equity, as it's also known. So risk tolerance. You have to know yourself. Okay, how risky are you willing to be with your money? If it's money that you can afford to lose, if there's time on your side where if I lose it, I can afford to wait for the market to correct and come back. Risk tolerance. Volatility. You all hear them talking about volatility. What is that? Basically, just how volatile your stock prices are. Right? One day it's $100, and then next day it could be $85, it could be $70. That's a risk. That's a volatility. That's a stock that's very volatile versus a stock that's steady as she goes. Steady as she goes. Doesn't go up much. Doesn't go down much. Not much potential for growth. Steady as she goes. Volatility. Okay, you'll hear them talking about volatility. When it comes to volatility, stocks are more volatile than bonds, for example. Okay, a lot of times, you hear in the news or the stock market, S&P 500 is up 500 today. It's down, up 5%. My mistake. Down 5%. Up 15% year over year. Down 5. So that's very volatile versus other instruments that are pretty steady. Your bank account, there's not much volatility in your bank account, right? Yeah, we know it's steadily, it's gradually, the buying power goes down, but there's not much volatility in your bank account. That's a great example. You always hear the term asset allocation. So it sounds fancy. It's not really fancy. Asset allocation. We did a video on diversification. Asset allocation is simply how much money do you have over here, how much money do you have over here, because the economy is basically divided in sectors or categories, right? You have the materials sector, the company that deal with materials. You have the consumer non-discretionary. There are things that you actually need, right? There's no choice. Medicine, food, utilities would be in there. You need power, you need electricity, you need water, you need medicine. Then you have the consumer non-discretionary. We don't really need to go to the movies. We don't really need fast food. So this would be like, yeah, you could take it or leave it. Clothes, retail. Then you have the pharmaceuticals. You have so there's different sectors, and asset allocation is how do you have your money spread out? How much percentage do you have over here in stocks, and how many percent do you have in bonds, and how many percent do you have in cash. That's what it means, asset allocation. You'll often hear the term time horizon. All that simply means is, how long do you see yourself being in the market, okay? Somebody who's 20 years old starting their first job, they can see themselves maybe 30, 40 years in the market. Where the person who is maybe in their 50s or mid 50s may say, I'll probably be here for another 15 years before I'm going to start collecting. So your time horizon. Your time horizon is sort of linked to your risk tolerance, right? And it makes sense. If you're a 20-year-old person with your first job, you can be very you could be very risky or have a very high risk tolerance. You can put your money all in stocks, nothing in bonds, because you have a long time horizon. So what if the market drops? Let's keep buying on the way down at a cheaper price. I have a long time horizon to make my money back. Quick example: someone who was about to retire in 2008, right? They have if we go back to the market correction in 2008, the downturn. If you were about to retire in 2008, right? In 2007, you had a very short time horizon. You had 1 year to go. So that's a person that really wouldn't want to be that risky, as opposed to someone who's going to retire in 2050. In 2008, that was nothing. I have a long time. I don't care if the market drops. I'll keep buying. So time horizon. Diversification, guys. Diversification. We can touch that. It's very closely linked to asset allocation. You do not want to have all your eggs in one basket. Diversification. You don't want to have all your eggs in Apple, all your eggs in Google, all your eggs in McDonald's. So you want to spread it out a little. Diversified. You want to be diversified across different industries, different sectors, even different sizes of companies. Large cap, mid cap, or even different regions. I don't want all to be in U.S. I want a little international exposure. So diversification. Sectors, we kind of touch that. Sectors is basically just the same thing as the different portions of the economy. I have some money in the utility sector, in the finance sector, in the pharmaceutical sector, the materials sector, in the utilities sector, in the consumer discretionary, consumer non-discretionary. You kind of see where this is going. You basically are diversified, just like your mom always told you, don't have all your eggs in one basket. Capital appreciation. All that means is your price of your stock is going up. You bought it for $100, and now your stock is now worth $110. You have realized capital appreciation. Okay, your stock price has went up. That's what it means when you're talking about capital appreciation. Dividends. Some companies pay dividends, which is just a portion of their profit they're returning to the shareholders. Okay, companies pay dividends. Some companies pay dividends, which is a portion of their earnings they pay out to their shareholders. Basically, the way of rewarding them for investing in the company. Great way to make passive income. We're going to have tons of videos on that. We're going to talk about that. We're going to go deep on that. It's a great strategy. Dividends. You hear the term growth investor. Are you a growth investor? A growth investor is basically someone who's investing for the capital appreciation. Buy low, sell high. I bought this share for $100, and I'm going to hold it, and I hope that it goes up from $100 to $150. That's a growth investor. They bought low and they're going to sell high. And the difference is the profit they made. Okay? Growth investor. And likewise, there are certain stocks who are known as the growth stocks. You know the name: Facebook, Apple, Facebook, Google. They're known as growth stocks. They don't pay dividends because the company's management feel that they can best invest the earnings back into the company to grow the business. So growth investor, they invest for capital appreciation, and growth stocks, likewise, they go up in value. They usually do not pay a dividend. And companies go through cycles, right? Microsoft, Apple, initially, when they were first starting, they were growing. They did not pay a dividend because they were reinvesting in the business. And as a company gets more mature, it's one of the stages they go through. When they become more mature, as they get larger and larger, they can't grow as big, and they have all that money that's laying around. And they say, what can we do with that? If we keep it all, the government is going to tax us, well, we can reward our shareholders. So most of the companies that pay dividends are well-established companies. Name, McDonald's and Johnson & Johnson and Procter & Gamble. These companies, they're big, and they're not growing as fast as your growth companies, but they're so huge market capitalization, and they have all that money they paid out to their shareholders. Dividend investor, company, a person that invests primarily for dividends. And dividend stocks, likewise, are companies that pay dividends. Like I said, not all companies do, but some of the more mature, big names, they do. Let's compare active investor versus passive investor. We've talked about it before. Active investor versus passive investor. An active investor would be someone who's actively going out and picking individual companies. So they want to go study and research and buy Apple, or they want to go buy AT&T, or they want to go buy whatever. They're actively going out and investing in individual companies. You compare that to passive investor. A passive investor is someone who don't pick individual stocks. They'll buy, and they're talking buy entire index or entire ETF. We'll get to that. And but basically, they're buying, it's like a whole group, a whole basket of stocks. You heard of like the S&P 500 index. You buy the whole thing. Okay, so when you buy one share of that index, you're buying a little piece of the 500, the biggest companies. That's considered a passive investor. Once you made that decision, you're buying everything. Okay, it's a great way to go, guys. It does save time. Okay, stock exchange. We know them. You're reading the news, watching the news, and they say, well, the New York Stock Exchange is blah, blah, blah. Or so certain stocks trade on the New York Stock Exchange. It's basically an exchange or marketplace where stocks are traded, bought and sold by investors. Certain stocks are traded on the New York Stock Exchange. Certain stocks are traded on the NASDAQ. And then you have international. You hear of, like in London, it's the FTSE. So it's just a marketplace where stocks are traded. You'll hear terms such as developed markets versus emerging markets. Developed markets would be considered like the U.S., Europe. They're considered developed markets. And some of the countries, who are not as developed, maybe India and so on, they be considered emerging markets. Okay, and the reason why this is important, a lot of times people want to be diversified, and they want to be diversified sometimes across regions. So they don't want to have all their money, all their stocks in only U.S. companies, because if the U.S. has a crash, all their money is in one region. So they want to have a little money in international. Okay, so emerging markets. Then you could contrast it with like developed markets, like the U.S. and London we're talking about. Sometimes you'll see like an index, and it's called like developed markets or all world X U.S., meaning all developed world markets. So they may have stocks in the U.S., they may have stocks in London, they may have stocks in India, but except the U.S. All part of diversification. You've heard a brokerage account. A brokerage account is nothing fancy. It's basically an account in which you hold your securities, your investments. Okay? A brokerage account is similar to like a bank account, but instead of having money there, you have securities, you have stocks, and you have bonds, you have investments there. Okay? And you need that. That's how you trade. Brokerage account. Capital gains. We basically touch on that. You'll hear the term capital gains, capital gains, capital gains. Capital gains is basically when you hold. Capital gains is basically the profit you made off your investments. You'll hear two terms. You'll hear long-term capital gains, and you'll hear short-term capital gains. Long-term capital gains is if you hold your security, you hold your stocks for greater than a year, it's considered long-term capital gain. So you hold your stock for greater than a year, the profit you made is considered long-term capital gain. And why is that important? It is important because it is taxed at a lower rate. It is taxed at a lower rate. The government is incentivizing you to keep your money in the market, keep investing in America, keep investing in businesses, and they can reward you by giving you a lower tax rate. You compare that to a short-term capital gain is stock that you have held for less than a year. You get taxed at ordinary income. So whatever your ordinary tax bracket is, you'll get taxed on that if you hold the stock for less than a year. That's why there's a consequence to buying and selling, jumping in, jumping out. There's a consequence. You jump in, right? And you buy it at 100, it goes up to 200, so you made $100 per share. You sell it less than a year, you're gonna be taxed at $100. You're gonna be taxed at a higher rate, at your marginal tax rate. Okay, guys, we're almost coming to an end. I know this is a lot of definitions. Let's go to last couple, and then we're done. Bull market. A lot of times you watch TV and you hear, oh, we're in a bull market. A bull market is nothing more than a market in which prices are rising. Prices in the stocks are rising. You also hear them use the word equity for stocks. In a bull market, prices are rising. So you'll hear them say something like, we are bullish on Chipotle. We are bullish on this company, meaning that we feel that the prices in this company are going to rise. That's what it means, bullish. You compare that, or you contrast that with bearish. A bear market is basically a market in which prices are declining. And when they say we're bearish on this company, we're bearish on this stock, they feel that the prices are going to go down. Okay? Prices are going to go down. Okay. You can actually make money in both markets. We always think that you can only make money when prices go up, but you can actually make money when prices go down too. You'll hear them say, we're shorting this stock. We're shorting this stock. What does that mean? When they say they're shorting that stock, that means that they're going to, they buy the stock at $100, right? They're going to buy the stock at $100 per share, and what they do is they borrow the money from like a broker, and they buy the stock for $100. And so because they don't have the money to buy it, so they borrow it, they buy the stock for $100 a share, and say if they're hoping that it will drop from $100 a share to like $50 a share. So then what they'll do is, when the stock drops to $50 a share, they will sell it, okay? And when they sell it, they give the money they made back to the brokerage. So let me try to explain it a little better. So the stock is trading at $100, right? They borrow $10,000 from his brokerage account to they buy say $10,000 worth of this stock. They don't have the money, so they borrow the money from a brokerage account. Now in their account they have $10,000 worth of this stock, right? Say it's $100 a share. The stock dropped, price dropped, because that's what they were thinking. They were shorting it. They think, some bad news is going to come out. They believe something's going to happen. It's going to drop. Now the price drop of this stock to now only $50 a share. Now they can buy it at a lower price and give the money back to the brokerage account. Say, here is your whatever 20,000 shares or whatever. They've now given them back the $50,000 share or whatever. The same amount of share they've given them back, but for a cheaper price. The difference between what it was here and what they sold it for is what they will profit, minus all the fees and commission. So the short term is you can make money in both markets, but we're not going to get bogged down in that. Market correction. You all think I'm talking about a market correction. A market correction is a decline in the price of the stock or equity or the market of 10%. When you look at the chart for a stock, it doesn't go straight up, right? You see these little dips, it looks like the teeth of a saw, right? It may go gradually going up, but these little dips something they call them buying opportunity because they're dipping. Okay, so market correction is a decline in the price of the shares or the stock or the market about 10%. And a more severe correction, what they call a market crash, is a decline of 20%, at least 20%. A decline. Remember the 2008 market crash, the early 2000 dot-com bubble, in 1987, what did I think they call them, Black Monday, and of course 1933, the Great Depression, right, where I think the stock market lost probably more than 80% of its value. So just some quick definitions today, guys, so we can be on the right page when we hear terms. They don't confuse us or make us feel like we're not as intelligent as the next person. We can learn just like everybody else. MD Investor again in the house, guys, talking about investment terms that we need to understand. If there's people out there you think could benefit from this information, pass it on to them, guys. This is 2020, and we're going to take action. Remember to invest, definitely, but definitely remember to hit the subscribe button. Okay, hit the subscribe button. Definitely hit the notification bell when new content comes out. On Instagram, it's MD Investor 1. And remember to command your money to grow. We will see you on the next one.